the Fed get more dovish over time. They kind of finally ease their hawkishness. But what we saw in this recent week was that the Treasury came in lighter than expected for how much deficits they're expecting to run over this next quarter or two. And we also saw the Fed push back a little bit on the dovish narrative. They kind of reaffirmed some degree of hawkishness. They kind of took March rate cuts off the table, and they kind of delayed any sort of dovish action outright. I've in the view of either no recession or soft recession, and the way I describe that is kind of sector-specific recession, or the type of recession you generally see in emerging markets, which would feel quite different than a recession you get in typical developed markets.
Lyn Alden, a macroeconomic analyst and investor. In this video, she will explore the divergence between fiscal and monetary policies. She will address some of the key questions that many investors have, such as: how does the gap between fiscal and monetary policies impact different sectors of the economy? How likely and severe is a recession in the U.S., and what are the signs to watch out for? How do the recent announcements by the FOMC and the Treasury affect the outlook? How are some equities overvalued, and what are the risks they face in a downturn? How can investors analyze the market's challenges on a sector-by-sector basis? Let's hear the answers to these questions. Wait a minute, everyone. Get ready for the ultimate crypto investing website, the Bitcoin Seller. It's your golden ticket to an exclusive insiders club. Expert predictions, on-chain data, and breaking news, all for you. Imagine all crypto insights landing in your inbox daily, like having your own expert team. Don't miss this VIP opportunity. Click the link and secure your spot. Join now and ride the crypto roller coaster with the Bitcoin Seller.
I think the description of the macroeconomy is that we've had one of the biggest divergences between fiscal policy and monetary policy in recent memory. And so the general tightness of monetary policy is higher than normal. And at the same time, the looseness of fiscal policy, meaning the size of the deficits, especially relative to the size of the economy, is larger than normal, especially outside of a recession. And so that gap is resulting in sectors performing like their divergence in performance almost couldn't be wider than it has been in history. So, for example, things that are not sensitive to interest rates, at least as much, like profitable tech companies or restaurants and travel, things like that, they're generally doing quite fine. Whereas when you look over at commercial real estate or unprofitable tech companies or things that in general are either highly reliant on issuing equity or highly reliant on kind of shorter moderate term debt, those are the industries that are really struggling, especially if they've also been impacted by changes, things like work from home. And so this everyone's kind of focused on the question of recession or no recession, whereas I'm generally finding that some sectors are already deep in recession, whereas other ones are booming. And so you have to kind of answer that question on a sector by sector basis because you have this bigger than normal gap. And so the FOMC meeting and also the Treasury announcements this week were informative. They showed us a slight diversion from the trend we've seen over the past quarter. So, the past couple quarters, we've seen larger and larger fiscal deficits, a lot of bond issuance, especially a lot of short duration, like bill issuance, which is really good for liquidity. We've also seen the Fed get more dovish over time. They kind of finally eased their hawkishness. But what we saw in this recent week was that the Treasury came in lighter than expected for how much deficits they're expecting to run over this next quarter or two. And we also saw the Fed push back a little bit on the dovish narrative. They kind of reaffirmed some degree of hawkishness. They kind of took March rate cuts off the table, and they kind of delayed any sort of dovish action outright. And so I think we're seeing a little bit of a consolidation with expectations going forward. But I think the overall structural view is still the same, which is that you have relatively tight monetary policy and you have relatively loose fiscal policy. I've in the view of either no recession or soft recession, and the way I describe that is kind of sector-specific recession, or the type of recession you generally see in emerging markets, which would feel quite different than a recession you get in typical developed markets. So when people think of recession now, they often think of either COVID or they think of the 2008 financial crisis. Whereas, for example, if you go back to the prior recession, you had the 2001 recession, which was obviously very bad for equities given how overvalued they were. But the actual recession itself was quite mild in terms of the unemployment rate, in terms of the GDP contraction, in terms of what other sectors did. It was not a very severe recession by most metrics. And I think that to the extent that we do get a recession, and I admit, in 12 months, there's a lot that can happen. But to the extent that we do get a recession, I would expect it to be more like that 2001 variety where some of those unemployment statistics and some of those GDP contractions are maybe not as severe as people fear, but that, of course, can still have very big implications. I think one of the biggest concerns in the markets is that a lot of the bond proxy type of equities, so, kind of defensive, high quality equities, a lot of them have been bid up to very high valuations. Costco, for example, it's a great company, but the stock is trading at valuations that make it look like they're doing AI or something, right? And so you
Exactly.
have that problem. Yeah, you have that problem where if you get even a middling economy, let alone a slightly recessionary economy, those valuations are just hard to justify at these very high levels. So I think it's very sector specific out there.
Lyn Alden examines the macroeconomic situation, focusing on the divergence between fiscal and monetary policies. She explains how this divergence affects different sectors of the economy and how it influences the likelihood and severity of a recession. The Bank of England's own economists predict that the UK economy will likely enter a recession if the bank keeps rates on hold, as inflation pressures ease and growth slows. The IMF's optimistic view of the global economy in 2024, citing the positive effects of artificial intelligence, lower interest rates, and stronger demand on growth and inflation. Lyn also comments on the recent announcements by the FOMC and the Treasury, and how they affect the outlook. She warns about the high valuations of some equities and the risks they face in a downturn. She advises a sector-by-sector analysis of the market's challenges, the trade-off between inflation and recession, and argues that the global economy is at risk of overheating due to the combination of monetary and fiscal easing. Strong growth doesn't cause inflation, and reducing inflation doesn't require a recession. Inflation is the result of an imbalance in the supply and the demand for money. Bringing down inflation requires that the Fed address this imbalance, typically by increasing or reducing interest rates. If interest rates are too low, they will only stimulate inflation. If interest rates are too high, disinflation or deflation will be the result. And do not forget to subscribe to Bitcoin Seller. The most important news will reach your inbox on a daily basis and for free. I do not know why you have not subscribed yet. If you like the video, give it a thumbs up and subscribe for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.